The stock market sneaked into positive territory today after 7 weeks in a row of the index being in the green. And we are comfortably above the once psychologically important level of 5,400. Well, 5,407, not quite comfortable, but at least we're above. So what is Macquarie anticipating lies ahead for the market? How are you, Martin?
Pete, I'm well. How are you?
Martin Lakos, in case I didn't...
It sounded good, but yeah, 5,407 is not really that comfortable, is it?
Well, when I said...
It's played with that level.
Yeah, that's right. But it's great it's over and stayed over.
Right.
Until recently, we couldn't get through it, but bang, we go back down. What do you think of this market? Because my feeling is we've done this, I calculated on Saturday, we're up 14.8% since February 10.
Yeah.
Great rise. But you kind of think they're going to have to test us again. You kind of think that,
You'd think so. And certainly our view in the short term, Pete, that given all of the what appears to be headwinds, and it may come to nothing, but you know, there's Brexit, the polls are looking slightly in favour of staying in the EU, but that's not a done deal. You've got the June meeting ahead of Brexit from the US Central Bank, the Federal Reserve.
You think yes or no?
We're on the Fed. We're looking for June.
Yeah, because in America you guys are called Macquarie.
Yeah.
But you're very popular over there.
Yeah, we're well known. We're well known. Yeah, our analysts are doing a great job.
Your guys are kind of expecting a June.
We're looking for a June rate rise, and it's largely on all the data that's come out. So last week we had home sales, very strong. Inflation's starting to pick up a little bit, particularly that underlying inflation number. Which
we want inflation nowadays, don't we?
We do. There's not enough inflation. Yep. So we think the data suggests that there is a rate rise coming. Now, it may be July, but our forecast is June. It's more around the fact that now it does appear, particularly global investors, are getting used to the fact that the economy is strong enough to take further rate rises. And then we're looking for another one before the year is out.
It's a great sign, really, because that was the fear that Bernanke would try QE, it wouldn't work. You remember those people, what, QE infinity? You know,
well, I mean, just look at January, February of this year. I mean, we're only talking 3 months ago, and the markets were very concerned about global growth, the US. I mean, there were some commenters out there talking about a recession in the US, which is just not around the corner.
Those people should be, their pictures should be put on television regularly with dunce hats.
Let's just not go there.
Dunce hats on their heads.
No, I can't.
You wouldn't do that. I'd do that.
Right. Okay.
I'd love to do that. Dunce hats.
So there's still some headwinds. There's still some headwinds in front of us.
Yeah.
The conventions for the Republican and Democrat Party, although we obviously would gauge, we know who the candidates are going to be. But the question is, you know, again, leading from July to November, what are those candidates going to start? How are they going to start to perform? Just a few things out there that might
to me,
the
June rate hike is the one that I'm more interested in.
Yeah.
And if the market can get over that, I think there'd be a real step in the right direction for the whole global economy as well as financial markets.
Well, a few indicators really early, Pete, but the volatility index, the VIX in the US, is just starting to rise. So traders look like they're trying to take some hedges around the possibility of some further disruption. But we don't see huge downside because the data around the world, China, US, is still supporting where the economies currently are.
So well may it stay that way.
Well, let's hope so. But you know, wouldn't be surprised to see the market just pull back a little bit on that those risks.
Okay, so what's your outlook for the banks?
Well, our strategist, Jason Todd, has got a modest overweight position. He's been there for a little while. Our bank analyst within the sector...
I like Jason a lot.
Thought you'd like that.
Yeah, I like that.
And look, it makes some sense to be overweight the banks given the interest rate environment. So if you put it into that component of the income plays, it's obviously the banks. You know, there's Telstra, there's Transurban, there's Sydney Airports, all of those utility infrastructure stocks.
REITs are probably going to keep on doing well.
Nice and strong. The REITs look fully valued, but are probably going to hold up. Just talking property, we like Goodman Group, we like Westfield, we like Lendlease. They're more international stories and currency stories, but we like that space as well.
What about the Lendlease management? There's a company I've never really studied. I know a few good executives there, but what's the Macquarie view on Lendlease as a company?
Well, the company's basically reinvented itself over the last number of years, and now the big growth driver is going to be, in fact, their offshore businesses. So they're definitely a major player in tendering for all of these big re-urbanisation projects that are taking place in the UK and in the US, and that's what it's going to drive.
The Barangaroo thing, was that a good thing for them in terms of growing their reputation?
Well, both in reputation and also, look, although it was a lower margin project, but a very, very large project, you know, they've done very well out of it. But most of that is in the numbers as far as analysts are concerned. So looking to the future, it's more the offshore space, most definitely.
Okay, but banks, so Jason Todd, was it?
Jason Todd's our strategist.
I remember, yes. He likes the banks?
Likes the banks.
Okay. But
modestly.
Yeah. But guys like Brian Johnston, who's been like a doyen of bank and analysts.
Sure. Brian is ex-Macquarie.
Yeah, he's pretty negative on the banks, isn't he?
Yeah, I think, to some extent you can get a little bit overtaken with the focus on impairment charges, and there's no doubt the banks were looking very cheap for quite a while. Some months back, you and I spoke about that. Yeah. The banks were selling...
Great buying opportunity, I think we pointed out.
We talked about that. It's Commonwealth Bank around 72, obviously, but the banks were selling on a 30% discount to the market. They normally sell on about a 15% discount, so they've recovered some of that big discount. So not as looking as cheap as they were. But in the environment where we think interest rates are going to go lower here in Australia, you would think the banks...
You guys are 1% on the cash rate, aren't you?
For next year, not for this year.
Okay.
Yeah, we think it's the bottom of the cycle.
Okay.
That environment is going to continue to provide some support for the banks around these levels, given 5.5%, 6% yield plus franking.
Yeah, and I think the important point is, and I'm actually going to take this up with my colleague George Baburis in the next segment. A lot of bright guys like Brian Johnston can come out and say, all right, I think a great term, dividendosaurus. It's like an old, ponderous relic, the banks. But the reality is some investors don't want to shoot the lights out. And
from a capital perspective,
right. They don't need to get fantastic capital growth, where Brian might be saying, well, there's better stocks out there for capital growth, don't expect much. But some people might be just happy with the 7 or 8% with franking credits returns on banks.
And look, our perspective is definitely around the growth. The banks are in a low growth from an earnings perspective, a lower growth environment, there's no doubt about that. Yeah. But we think the dividends are still intact. It may well be that the banks keep the dividends in absolute dollar terms steady. Yeah. The earnings will grow somewhat. We'll see those payout ratios, that's the amount of earnings gets paid in dividends to shareholders, start to come down. The market will be a bit more comfortable about that. But the risk for the banks is clearly around impairments, and that's the catchphrase at the moment. We watch it pretty closely. We've done a lot of work on that. Yeah. But we're also very comfortable the banks are doing a lot of stress testing on their loan books, and we seem to be comfortable with that as well.
And it seems to me the CEOs of banks know how disappointed the market gets when their profits and their projections aren't good. So they would be pretty, they would be pretty careful about making sure that they inform the market pretty well.
Well, they have to inform the market quite clearly.
So big shocks aren't likely.
Most unlikely. But again, it's around those expectations of the market. But generally, those expectations seem to be managed quite well.
Okay. When people tune in and see Martin Lakos on the Switzer program, they say, what's Martin's favourite stock for the week? And is there one? You mentioned some already, like Goodman Group and stuff like that. They've been very generous. But what's your favourite stock for the week?
Well, if you're looking at where there's some momentum, and you've got to be careful just being a pure momentum player, but have a look at, Pete, at the healthcare space or pharmaceutical space. So CSL is $116. Now, on a valuation basis, it looks pretty expensive, but the market is rewarding that stock for consistency, its position in the global blood fractionation market. Cochlear, it's number 1 or number 2 in its space in terms of the segment, and that stock's going from 103 to 120. So I'm not suggesting for the moment to be racing in and buying those stocks today at those prices. But if you see any pullbacks, we think there's further upside over time because they're very well managed. They've got this key component of being number 1, 2 or 3 in their segment. They're big beneficiaries of a weakening Aussie dollar, and we think that's going to continue to go down over time. So that's certainly that sort of area of the healthcare space we like a lot. And again, those 2 stocks are in our Jason Todd's thematic portfolio.
Go for it, Jason. One last question. What are you guys thinking about GDP on Wednesday?
Yeah, look, that December number was pretty strong. It beat most analysts' expectations, except for one, apparently.
They're very optimistic. Peter Switzer got it right, but go on.
We know the March quarter has been softer around the world. Don't forget we had a stronger Aussie dollar, so we would expect a quarterly number of 0.6, which would equate to a year-on-year number of about 2.7. Got to put this in perspective, Pete. Our forecast for next year for our economy is 2.2. Now, our economist...
I hope you're wrong, by the way.
Well,
but
it's a forecast, and our analyst is below consensus, but we see the economy continuing to track below trend, and we're going to get a lot of data out this week. Retail sales, building approvals, the trade data, manufacturing and the GDP. So there's a lot of data for the market to absorb here.
Yep. If the information's good, it'll be a ripper for Malcolm Turnbull. But if it's not, it'll be a stripper. He'll lose a few rating points, that's for sure. All right, buddy. Good
Thanks,
to see
Pete.
you. Martin Lakos from Macquarie. Now, coming up after the break, we'll have George Baburis from Contango Asset Management to continue my conversation around banks and other great dividend-paying stocks.